real power play is really happening in the Far East, in China right now, especially with the kind of commentary that you're hearing from Xi Jinping. He's now encouraging more private participation, more private entrepreneurship, initiatives, especially when it comes to the tech sector. And his meeting with Jack Ma after a long, long hiatus is sending very different sort of signals out in the market. Even if you were to stack up how China has performed vis-a-vis the rest of the world, if you were to just take stock of how the indexes have done, look at the last 1 month performance. The CSI has seen an uptick of about almost 3.5%. Hong Kong has jumped up almost about 15.5%. In the last 6 months, the data looks much more exaggerated. It's a 30% return that you've seen on Hong Kong, CSI 300, 18%. So is this still just tactical a play? Because this is definitely denting a lot of those FIIs from coming back to India, because money is surely moving to China. Let's try and understand all of that. We've got Shaun Rein, China Market Research Group, founder and director and author of the book, The Split, Finding the Opportunities in China's Economy in the New World Order, joining in on the show right now. Shaun, great to have you today on the show. Welcome once again. Shaun, first things first, what explains money moving back to China? And is the nature still tactical in nature, or do you think that structurally people are finding value in China, maybe because of just the valuations?
Well, great to be here. Happy Year of the Snake to you and all of your audience. Basically, what you've seen is a lot of tactical money is coming in from global investors back into China. You know, the Indian stock markets are down about 20% in the last few months. So a lot of international investors are saying, you know what? Do we want to have exposure to India, or is it time to pull back? And where are we going to put our money? It's China. Why? Because you look, the MCI China index is still at about 11 PE ratio, while India's is at about 20. So in my mind, over the next 2-3 weeks, there's still room to grow as the Americans and the Europeans leave India, leave Japan, and come back into the China market, because the PE ratios, the valuations are way too low, even though, as you rightly said, we've seen a 30% bump up in the last 6 months or so.
Is China a case of once bitten, twice shy? Because all the arguments for China and why one should invest in China, I think, are perfect. It's cheap, it's underperforming, the economy is coming back, and now there's very little to lose after years and years of underperformance. But unfortunately, for those who've invested in China in the last 10 years, they've burned their fingers, actually burned their hand.
Yeah, so that's a great question. So I think if you put money in and hold it long term, you have burned. But if you put money in, hold it like great stocks, a company like BYD or Xiaomi or CATL, you hold it for 3-4 months, and when it hits the top, then you sell. So I think China's market is very different from, say, the United States. In the US, 80-90% of the market is controlled by institutional investors. In China, it's the other way around. 80-90% is controlled by retail investors. So it's kind of like you have 90 million hedge funds in China. So if the market goes up, everybody puts money in. It's a psychological win. But as soon as things start dropping, everybody retreats back into cash or gold, which is why gold prices went up 10% last year. So what I recommend to investors is you absolutely have to be betting for China, but it's not the type of place where you put your money in and hold the stock for 1 or 2 or 3 years. The geopolitical risk is too high. The domestic policy making is too uncertain. So you got to put money in, and you might want to pull that money out in a month or two. That's what smart money does. It's almost more speculation than investing in many ways.
So for our audience here who always wondered that what is the best way to diversify, in your analysis, you would say that take a leap of faith in China. If not 10, maybe 5% of your near-term tactical allocation should go to China?
Yeah, I would be recommending 10-15% of your global allocation to China, especially the tech sector right now. I think yesterday you saw Xi Jinping, the president of China, met with a lot of the tech leaders, like the founder of DeepSeek, the AI company, Pony Ma, the founder of Tencent, and really importantly, Jack Ma, the founder of Alibaba, who's sort of been out of the spotlight for the last 4.5 years. He's now come storming back in. This was a very strong signal from the CPC that they want to support the technology sector again and that they want to support private enterprise. Let's be really clear. What's happening in the economy right now and why it is so weak is not because there isn't enough monetary policy in the system. There's enough money here. The problem is there isn't enough confidence. Chinese households are sitting on about 20 trillion US dollars of savings. SMEs also have savings. Chinese are much bigger savers than those in the United States. The problem is nobody in China wants to buy anything, which is why there was only about a 3-4% increase in retail sales last year and an anemic about 0.1% on fixed asset investment for SMEs. The key is people want to know, is Xi Jinping pro-business or not? Is Xi Jinping going to continue the regulatory crackdown on the tech sector like he has for the last 4 years? I think yesterday's symposium was a signal to the world that China's back open for business again. Technology is good, private sector is good, and that's why, retail investors in India should think about getting a 10-15% exposure to China, first in tech, but frankly, 3 to 6 months from now, I think the Chinese consumer will start spending again.
Exactly, Shaun. Very good morning, Cheryl, also joining the conversation. That's exactly what I wanted to ask you now. Now, do you think that the policy will shift towards consumption now once again for China, given the fact that you already have the tech sector taking the world by a rage with what exactly happened with DeepSeek, and now you have a lot of investment coming into the AI-related counters as well in China. So now you think that policy will shift towards the consumption space back again in China?
So the government has actually already focused on spurring consumption, and this a misnomer in Western media. They've done a lot to make education and make healthcare more accessible for Chinese households. If you can send your kid to school and send them to the doctor, the theory is that you'll open your wallet to go out and spend. That hasn't happened the last several years. And the main reason why is the overhang of geopolitics. US-China tension, which I write about in my new book, The Split, has scared the Chinese consumer. They're worried that the United States is looking to contain China through their crippling tariffs, export sanctions, and export bans. And so a lot of Chinese have been saving their money for a rainy day. They're worried that the Americans will do to China what the Americans have done to North Korea, Iran, and Cuba and impoverished generations of people there. So everybody in China has been just saving onto their dollars. They haven't been spending, not so much because of domestic policy issues and poor consumer-oriented policies, but more the fear of geopolitics. But now we have the new guy in the room, Donald Trump. Chinese tend to prefer Trump over Biden and Harris because they feel that he's not an ideologue. It's not a fight anymore between liberal democracies and communist autocracies. This is now Trump who's trying to grab as much benefit as he can from Canada, Panama, Mexico, the EU. He's not trying to destroy China. So there's a feeling, especially with DeepSeek and how they have a new language learning model that's as good, if not better, than open AIs, that China can beat the crippling sanctions. China can beat geopolitics, and Trump isn't going to be as morally wrong as Biden was. That, more than anything, is what's going to get the Chinese consumer to go out and open their wallet. And I think that'll happen 6 to 12 months from now. So this is a good time for investors to buy stocks that are on the cheap on the consumer side, which is why I like Xiaomi, I like Luckin, I like PopMart. These are all cheap plays that the Chinese consumer will want to go for. Proyan Cosmetics is another good one.
Right. Shaun, but when you look at a global perspective right now, right? Yes, China has turned out very well as a play over the last 6 months. A lot of fund flows are moving to Japan as well. But then there is US, wherein, just the dollar parity is keeping money there, and those markets as well are doing good. In fact, some of the European indices as well are sitting at a fresh record high. Just wanted to understand, from an FI perspective, do you think that money would continue to remain within US? Or, could there be a chance that you could see flows move out from the Western markets and maybe to China, Japan too?
I don't know when it's going to happen, but America is going to have a major financial crisis. You can't have $36 trillion in deficit. You can't have so much money tied into the FANG 7 top stocks. It's an absolute bubble in AI. I think that American investors are going to start looking outside of the United States. It's sort of been the must win, must gain, no brainer investment in the United States over the last 3 years because of what I consider to be an irresponsible Fed by increasing the money supply so much. But at some point, it's just not sustainable. So the international investors are going to look abroad. Where are they going to go? So Japan has already had its run up, and everybody's cheering that at 0.7% GDP growth in Q4. 0.7? That's anemic. India had 5.7% in Q3 of last year, and everybody was excited about India. But you know what? China's at 5.4% in Q4. So a lot of people have argued for 3-4 years that China is uninvestable. I think that's bullocks. China is definitely investable. And I think what's going to happen in the next year is a lot of these investors are going to shift out of the United States. They're not going to want to go to India. They're not going to want to go to Japan. They're certainly not going to want to touch the EU with all of their political crisis. So they're going to go to China. China is the next place to grow in the coming 6 to 12 months.
So if you have to, let's say, make one trade, not for 6 months, which seems to be China, but for next 5 years or 10 years, will it be US equities? Will it be China equities? Will it be India equities? 10 years.
10 years is a very long time. I would, for me, the next China is China. I think you're seeing a lot of anger in the global South or the global majority towards the Biden regime and his hypocrisy over Ukraine and Gaza. But now you're also seeing the global North or Europe and the NATO countries are angry at Trump for what he's doing with Ukraine and Russia. So what I see happening is the world is pivoting towards China. China is going to account for about a third of the world's growth over the next 5 years. So I wouldn't bet against China economically over the next 5-10 years. I think they're going to become the #1 global superpower from an economic standpoint. Now, equities is a slightly different issue. As you are right, many investors have had their hands burnt over the last 10 years if you just put your money and hold. I think China is a much higher risk, high return type of environment. You can only put money in if you're willing to lose it. I think it's not a safe place just to put money in for 10 years and hold it unless you really know where you're investing and you trade in and out on a regular basis. But in 10 years, China is going to be the new global superpower because of the geopolitical chaos that the United States has started, not just under Trump, but also Biden. There's a lot of anger in the global South, or what I prefer to call the global majority, towards the hypocrisy in the United States.
Shaun, really appreciate your time. Glad you could join us, and thank you. Thank you for really, giving us this punchline. The next China is China.
Thank you so much for having me. Have a good day. Read my book, The Split.
Thank you very much. I look forward to reading that.